So you're watching the news, talking to lenders, and possibly even wanting to buy yourself a home only to realize that interest rates are creeping up. Everyone's wondering if interest rates start to go up, will there be a housing crash? And in this video, I'm giving you a simple and quick breakdown of a real world explanation that happened with me and my client literally yesterday. Pay attention, this one's gonna shock you. And by the way, if you get any value from my videos, please don't forget to hit that like button. It makes the videos float to other people who are interested in the subject just like you. Now let's get into it. House prices mainly reflect off of the interest rates. And yes, I understand supply and demand play a huge role, but interest rates motivate people to make purchases. And this isn't just for the real estate market, this is for all markets. Lower interest rates mean more loans, bigger loans, and more motivated buyers. Lower rates encourages everyone across the board to take more loans. The lower the interest rate is, the higher the housing market will be. The reason for this is if there is higher interest rates, there is a higher monthly mortgage payment. If there's lower interest rates, there is a lower monthly mortgage payment. And as you all know, if you watched my previous video, home buyers are buying monthly mortgage payments, not buying houses. I actually had someone comment below and say I'm subscribed just because of that saying. I guess they liked it. Home buyers are buying monthly mortgage payments, not houses. Hence why they're overpaying. Anyways, listen to what happened to me literally yesterday with one of my clients. They applied for a home loan about 3 weeks ago and they got accepted from the lender after they submitted their application. And the lender told them that based on their credit, their income and such, they could expect getting the average rate, which was 2.8%. However, they didn't lock the rate because the lender was still working some stuff and not everything was 100%, but he did guarantee that the rates were around 2.8%. And I knew that myself because I had other clients getting loans and their rates were similar. So at that rate, they were expecting to buy a home for $300,000, which put their monthly mortgage payment at $1,233. For them, they could afford that, they were happy with that, and they were ready to roll. I started to show them homes, not one, not two, but I showed them over 10 homes. I drove an hour there and an hour back from where I actually live, and we were out and about. So it's not like they got pre-qualified and then they just sat down and waited. No, we were moving and we were aggressive. Now, I'm sure that all of you have seen the news and noticed that recently interest rates have been going up. Of course, we know that rates fluctuate up and down every single day, but recently, this last week, they went up significantly, and that's a huge reason why the markets were actually shaky, especially the stock markets. So now as me and my client are shopping for homes, they actually found one, they loved it, we competed against 20 other offers, we ended up winning luckily, and now it was time to get our rate locked. Thank God for us, we were locking our rate when the rates started to go up. Now you might be saying, wait, you don't have to lock the rates right now, you can wait until they creep back down. No, every situation is different and we have to lock it now, otherwise we're gonna get delayed, have to delay closing, and who knows if the seller's gonna allow any of that. So we're in a position where we have to lock the rate at a higher rate, and we really didn't think it was gonna be this high. So the lender sends an email and goes, it's time to lock the rate and your rate's gonna be at 3.5%. I was mind blown, guys. I replied in that email furious. I was like, how do you go from a 2.8 to a 3.5, almost 0.70% higher? How in the world is this gonna happen? He goes, well, you know, man, the rates have been going up and this is what's happening and we can't control it and this is what the numbers are. And of course, the whole 9 yards. So that $300,000 home that we were planning to buy at 2.8% is now at 3.5%, which made the monthly mortgage go up $1,347 every single month. The difference is $114 that my client is now gonna have to pay extra every month. That's $1,368 per year that he could have saved or used elsewhere. Now you might say, hey, that's not a big deal, $100 something every single month. I mean, don't cry over it. It is what it is. Just let them move forward. No, it's a huge deal, and it's a huge deal for you as well. Let me explain. If you're a real estate agent and your client got pre-qualified within the last month, you need to call the lender and make sure that your client still qualifies. The reason is so many people who are looking to buy homes are purchasing with the maximum debt that they could take. This means that a $300,000 home, their monthly mortgage being $1,233, they were okay. But now a $300,000 home and their monthly mortgage being $1,347 a month, they're not okay because they already maximized their maximum purchase price and their debt to income ratio, with the loan being at 2.8%, assuming it was going to stay like that. So actually this $114 a month could potentially kick out my client and your clients, or even you who's looking to buy a home, if the rates started to go up, which they already have. This means that instead of qualifying for a $300,000 home, you are now going to get qualified for a home that's worth $274,600. Where a couple of weeks ago, you could have got a $300,000 home, now you're having to deal with a $274,600 home if you're trying to make the monthly payments equivalent. This means that the homes you've been seeing and dreaming of and looking at with your realtor are no longer in the picture, especially in a competitive market. This means that the PMI, the private mortgage insurance that you were paying every month that was going in the trash, on top of that, you're gonna have to pay another $114 extra every single month. Now, $114 a month extra seems doable to you, but not to many who are already maximizing their debt with their lenders. As you all know, there's a maximum debt you could take, and that $114 could take you out of that realm. And I'm only speaking for a $300,000 home. Imagine you're looking to buy a $800,000 home. Let me give you some perspective. If you're getting a $800,000 home, assuming the full $800,000 is debt at 2.8%, your monthly mortgage is going to be $3,287.16. Now let's just say you're in the same situation that me and my client are in. If you're getting that same $800,000 loan at 3.5%, your monthly mortgage payment is $3,592.36. The difference of $305.20 every single month. Now you're probably like, if someone can afford an $800,000 loan, then they can afford the $305. Guys, that's not the case. People actually maximize their debts. People actually spend every single percent of debt that they could take on to get the highest purchase price possible, because remember, people are buying monthly mortgage payments, not homes. So this difference for an interest rate going from 2.8 to 3.5 is very significant and should concern you. Now, those of you who are wondering about a housing crash and could interest rates actually cause a housing crash, this is supposed to bring perspective to you, to let you realize the potential is there and it could happen because of higher rates. Going back to our previous example of a $300,000 home at 2.8%, if you wanted the same monthly mortgage payment, you're gonna have to buy a home that's worth $274,600. That's a difference of $25,400 on the house value, the house price, which happened within weeks. Now let's just say that last month you bought a home at $300,000, 2.8%. This week, you realize that the rates went to 3.5%. That could potentially reduce your home's value by $25,400. Now, I'm not saying that's going to happen right now because, as we all know, interest rates are a big factor, but also supply and demand is another huge factor. And right now, we are having all-time low supply, all-time high demand, so that's not going to be the case for at least today's market. But let me tell you this. Let's just say that the builders start building thousands of homes, and then the supply starts to get very high and demand starts to get satisfied. Now you got a ton of supply, demand being satisfied, and interest rates going up. What do you think is going to happen to your home value? What higher interest rates, guys, will cause is the following. A, not qualify people for specific purchase prices they once thought that they could buy. B, make home buyers reevaluate what they could actually afford and can't afford. And C, calm down competition, because that person who planned to put $22,000 over asking price because it's only $100 extra a month on their monthly payment can't do that anymore because the rates went up, and that $100 that they were going to put for the over asking price is now going towards the higher interest rate. On top of all that, the markets will start to get shaky. So as you guys could see, higher interest rates will mean lower house prices because the monthly mortgage payments will start to go higher. And once again, people are buying monthly mortgage payments, not houses. Which shouldn't be the case because a smart buyer wants to get the best price for their home, but the reality is, in a competitive market that we're in right now, it's so rare to get get a home for the right price, especially if you love that home. So for everybody wondering how interest rates work, I hope this video made it clear. And also, if you are wondering will the housing market crash if interest rates go up, I hope this also clarified for you. There is big potential for that and you want to be cautious. Anyways, guys, thank you so much for watching this video. Make sure you hit that subscribe button. I post 3 times every single week and you don't want to miss out. I'll see you guys in the next video. I'm out.